For the first time in about the last 15 years, actually, investment grade yield to worst has become attractive again as part of the fixed income portfolio. So we haven't talked a long time about really getting heavily involved back in the bond market, but we've seen signs at the beginning of this year that things are moving, finally turning around. Remember, last year was one of the worst years in 40 years for the bond market. We're starting to see that stabilize. And as you can see in this chart, that investment grade has actually entered the green area, which makes it, as far as CNR is concerned, attractive range to start getting back into the investment grade corporate bond world. And I just want to explain something here. What yield to worst means is that most of the bonds out there have an ability for them to be called early. So if you looked at the fact that the bond could be called before the maturity date, that in essence means you'll make less interest on it over time because it got called early. But if we look at what the worst case is for that bond, that's what the yield to worst stands for. So the worst case, if you're getting into bonds right now on most of these investment grade corporates, they're over 5% yield to the worst that they can do. So if you hold them to maturity, they do great. They'll do better than the 5%. But if they get called early, the worst you're going to do is about 5%, which hasn't been around for a long time. As you can see, the yellow line is way below the green bar representing the range you want to be buying into this yield. And as also you can see on this chart, the blue line represents the high yield market. And there's about a 3 to 3.5% gap in expected yield. But again, these are high risk, very volatile, more volatile than your investment grade bonds. So you would expect to get a premium on taking that risk. And that's primarily where the market has been in the past few years because corporate bonds and investment grade bonds have been so low on a return that you had to take on more risk to get that return, as you can see in this chart.
Well, you know what I find interesting when you look at that chart there is going back to really when they were calling the secular bear market for bonds. You can see the mini bears and the mini bulls that are going on within there relative to the yield. And it's no wonder people are like, wow, do I get in bonds? Do I get out of bonds? It's a tough situation for bonds.
Yep.
But you're right. This could be a good time for, matter of fact, it is in many cases. And it's not just corporate bonds we're talking about. We're talking about treasuries, anything that's more investment grade on the bond part. There's really no need to worry. You take care of your family and
we'll take care of you. We're ready for the future.